Hey guys, Justin here. So UBS raised their price target for Tesla stock from $160 a share all the way up to $325 a share, which is over double their original price target. And if you are still adjusting from the new stock prices after the stock split, $325 a share used to be $1,625 a share. So in my opinion, this is a pretty significant price target increase for UBS, and I think it shows that despite Tesla's big run-up over the past year, the Tesla stock still has even more room to run. So in this video, I will discuss why Tesla stock can go higher, and in the process of doing so, I will explain why Tesla should not be valued like other car companies. But first, if you are not subscribed to the channel, go ahead and hit that subscribe button. This channel is growing fast, and a lot of my subscribers watch every single video I upload. So if you'd like to be notified whenever I upload a new video, hit the sub button and click that notification bell. Now, getting back to Tesla. Tesla is a very difficult stock to hold on to for a number of reasons, but the biggest reason is that it receives a ton of negativity. And to be fair, there are some stocks that deserve criticism. For example, Nikola has received a ton of criticism since going public, and honestly, a lot of that criticism is justified in my opinion. But when it comes to Tesla, I feel like a lot of the negativity comes from people who don't understand the company. Out of the 32 analysts that cover Tesla stock, the median price target is a respectable $297 a share. But the lowest price target is only $19. And the highest price target is a whopping $800 a share, which is over double the current stock price. The crazy thing is that if you look at the price targets for Nikola, which by the way doesn't yet sell any products or have any manufacturing facilities or really any proprietary technology of any kind yet, analysts are actually more bullish on Nikola. And in fact, the lowest price target is actually above Nikola's current stock price. So basically what I am trying to say here is don't listen to these analysts. In fact, just go ahead and ignore them because most of them don't have a clue what they are talking about anyways. But if you do listen to analysts, then you might have seen this article of a Wall Street analyst who called Tesla the most dangerous stock on Wall Street. And of course he said this as Tesla stock was plunging to try and incite more fear. But he justifies his statement by comparing Tesla to Toyota. He calls Toyota the most efficient car company of all time and also praises Toyota for their high margins. Which he's not wrong about that. But what he doesn't realize is that building an electric car is completely different than building a gasoline car. And when you talk about the technology inside of a gas car compared to the technology inside of an EV, there is one big difference that no one mentions, and that is time. Internal combustion engines have been around for over 100 years, while lithium-ion batteries have only been around for 35 years. So while engines in today's cars have benefited from decades of improvements and cost reductions, batteries for electric cars have not. Also, Toyota has high margins mostly due to their economies of scale. Tesla sold 10 million cars worldwide last year, while Tesla only sold 367,000. So if we treat Tesla like any other car manufacturer, it's not really fair to Tesla because they are using completely different technology. And also, Tesla's profit margins and their ability to scale could be completely different than existing automakers' abilities. For one, we don't know how cheap electric cars can get. Yes, right now, they are more expensive than ICE cars, but that could change very rapidly. In fact, I think the main reason UBS raised their price target for Tesla is because they are starting to realize how different Tesla is from other car manufacturers. One of the big catalysts that UBS cited in the report is Tesla's upcoming Battery Day, which will happen on September 22nd. And for anyone who follows Tesla stock, you are probably well aware of all the potential battery advancements that Tesla is set to announce. So I won't go into too much detail here, but the battery advancements will improve electric cars in virtually every way. These new batteries will improve the range and charging times for electric cars and will also allow them to last much longer than a traditional ICE car. Some rumors have even said a million-mile battery is possible, which would definitely blow ICE cars out of the water. But out of all the improvements that Tesla is expected to announce, the biggest one is the improvements in battery costs. And UBS specifically mentioned this as a catalyst in their report. You see, the biggest problem with electric cars is the cost of the battery. Right now, battery costs make up a very large percentage of the total cost of an EV, which means that Tesla has to sell their cars for higher prices. And this is not a problem unique to Tesla. The Chevy Bolt, GM's only electric car, is being sold at a loss right now, which at a starting price of around $37,000, it's not like GM is giving them away. Well, I guess they are since they are losing money on them. On the other hand, Tesla is already earning very generous gross margins on each electric car they sell, and their margins are actually going up each year as they sell more vehicles. In fact, in Q1 of 2020, Tesla had gross margins of 25% between all the vehicles they sell, which is higher than it was a year ago when they posted gross margins of 22%. So as you can see, GM is currently losing money on their electric cars, whereas Tesla is posting generous margins. And if we compare Tesla's gross margins to Toyota's, they are roughly the same. So Tesla is already matching Toyota in terms of gross margin, despite selling 25 times fewer vehicles. And like I said earlier, one of the biggest barriers for Tesla selling more cars is the high price of their cars. But here is where the improvements from Battery Day come in. UBS expects that Tesla's new battery technology will boost energy density by roughly 50%, which in turn will lower the cost of each vehicle by $2,300, according to UBS's estimates. This will help boost Tesla's gross margins even more. In addition to lower battery costs, Tesla also makes very high margins on its self-driving software. But I don't want to get into that in this video since really I want to focus on the battery tech. The thing I want you to take away from this video is that while battery technology has improved a lot over the past 10 years, it still has a lot of improvement left. In fact, if we look at this chart of lithium-ion battery costs, we can see the dramatic reduction in lithium-ion battery prices over the past decade. In 2010, the cost of a battery per kilowatt hour was a staggering $1,100. But by the year 2019, this number had fallen by 87% to a cost of only $156. And if we extrapolate this out, we can see that battery costs are expected to drop another 60% and should only cost around $62 per kilowatt hour in the year 2030. And while this chart is impressive, there's one more thing you have to understand about battery technology. This chart only accounts for improvements in lithium-ion batteries and doesn't factor in the possibility of next-generation batteries that could be even better than lithium-ion batteries. What I'm trying to say here is that battery technology is still in the early stages of development, and we don't yet know what the future holds for battery technology. Now, that being said, many experts expect that once battery costs reach $100 per kilowatt hour, that electric cars will cost the same as ICE cars. So if Tesla really can boost energy density by 50%, that would put them very close, if not under the $100 per kilowatt hour benchmark. Compare the potential future gains of battery tech to the potential gains of internal combustion engines, and the story is not as rosy. Internal combustion engines have been around for over 100 years, like I said, and the technology used in them has been heavily researched and optimized. And it is very unlikely that we will see huge improvements in the cost or efficiency of ICE vehicles. In fact, ICE vehicles are actually starting to become more expensive because of political mandates to raise their fuel efficiency. And when you try to squeeze out higher and higher fuel efficiencies, this has led to more complex engines that cost more and are more costly to maintain over time. So at a time when electric cars are getting cheaper and simpler to build, ICE cars are going in the opposite direction. And we are already seeing that although electric cars cost more to buy right now, they compare favorably to ICE vehicles over the first 5 years in terms of cost of ownership. A Model 3 compared to a Honda Civic shows that maintenance costs and fuel costs were 1/3 that of a Honda Civic over the first 5 years, which is impressive given that Honda Civics are known for their fuel efficiency and reliability. But for me, determining who will be the winners in the electric car race comes down to who has the best batteries. And when it comes to who has the best batteries, Tesla is already far ahead of all the other car manufacturers. And honestly, I don't see that changing anytime soon. Now, from here, there are literally dozens of additional things I could discuss when it comes to Tesla stock. But if we just focus on the battery improvements that are possible, then we can begin to see that it is very possible that one day electric cars will be cheaper than gas cars. Also factor in the cost of electricity, the fuel efficiency of EVs, and the lower maintenance costs, and it is also very possible that electric cars won't just be a little cheaper than gas cars, but that they will be a lot cheaper. And I firmly believe the future belongs to electric cars. So that is why I have been buying Tesla stock, and I will continue to buy Tesla stock as the growth story of electric cars continues to play out. Now, one final thing I want to talk about before I end this video is scale. Tesla is doing unprecedented things when it comes to being able to scale. For one, Tesla is building gigafactories all over the world that will allow them to manufacture incredible quantities of batteries. And as electric vehicle sales rise, battery production will be the bottleneck for manufacturing electric cars. So Tesla having the ability to manufacture a large number of battery packs will be crucial for them to scale. Also, Tesla just announced earlier this year that they are building an experimental battery cell manufacturing line in their Fremont facility. This would make Tesla less reliant on Panasonic and put them in full control of the battery manufacturing process from start to finish. The other thing that benefits Tesla when it comes to the ability to scale is how simple electric cars are to make. Electric cars have far fewer parts than ICE cars and therefore can be made more efficiently. Elon is also working very hard on robotic automation of the assembly lines, and even though he got ahead of himself on the Model 3 production, which led to very big delays, the lessons he learned from the Model 3 have allowed Tesla to get 3 months ahead of schedule on their newest EV, the Model Y. A lot of that is due to the increased use of robots for automation, but a lot of it is also due to smart engineering that has made the Model Y even easier to build than the Model 3. So at the end of the day, when you hear analysts compare Tesla to other car manufacturers, you have to realize that electric cars and ICE cars are completely different. And when you consider all of the factors together, it is very possible that Tesla could dominate the other car manufacturers in terms of both scale and profitability in a very short amount of time. Also, let's be honest. If it wasn't for Tesla aggressively pursuing electric cars, we wouldn't have the level of interest in EVs that we do today. So for me, every dollar I invest in Tesla is one more dollar they can use to accelerate the future of electric vehicles, which sounds like a good goal to me. Also, I'm secretly hoping that one day the gains from my Tesla stock will help me actually be able to buy a Tesla. But I guess for now I just have to wait. So if you found this video thought-provoking or interesting, make sure to hit the like button and drop a comment below. Do you feel like Tesla is overvalued, or do you see their stock continuing to rise? Also, are you buying Tesla stock at these prices, or are you staying away, or are you just trying to wait for it to drop down so you can buy it cheaper? Let me know in the comment section below. And with that, thanks so much for watching. I'll see you guys in the next one.